Good afternoon, everyone. If you can hear me, you can just reply with an emoji so we can know that we are not robots, we are human beings. So can you react with your favorite emoji so we can be sure? That's nice. We are all welcome to our second edition of our Skill Up Thursday. Last time we had a beautiful session with Lillian. I'm sure we went back to practicalize some of those things because I think I saw a couple of people's comments and their hashtag. This today we are, if you can see the slide, you can also react with an emoji so we can be sure that everybody is following. Can you react to an emoji if you can see the slide? Okay, so today we are doing financial planning and management, and it will be facilitated by the finance department. But quick information before we dive into our program today. I'm going to send a pre-test link for us to fill. Thereafter, by the end of the session, we'll send a post-test link so that we can fill also. The reasons why we are sending this is to assess our knowledge capacity as regarding the topic. So it's important that we all fill these links. So thank you very much as we dive into our training today. FM, sir, you can please proceed with your presentation. If you have questions, you can send them on the chat box. We'll respond to them. And by the end of his session, in the next 40 minutes, we'll have time for question and answer. Thank you so much. FM, sir, you can please proceed.
Good morning, good afternoon, good evening, depending on your location. I am Anthony Adakole by name, welcoming you to this second edition of Skill Up Thursday. Today, we are considering the topic under financial planning and management. We are considering cash flow and expenditure management in NGOs. And by way of introduction, we'll be looking at the concept of cash flow and cash flow management. Cash flow, as the term implies, is about the movement of cash into and out of an organization in the course of its normal business operations over a period of time. And when we say cash flow management, it refers to the process of tracking, analyzing, and optimizing. Hello, can you hear me?
We can hear you, sir. We can hear you.
Okay. So when it comes to the management of cash flow, it is the process of tracking, analyzing, and optimizing the movement of this money in and out of the organization over a specific period of time. So here we are actually looking at the essence. So what is the essence of cash flow management? The essence of cash flow management is for us to ascertain our liquidity position so that we don't run out of cash or even have excess at the end of the day. And when we are going to have excess or shortages, this can make us to have an informed decisions on what to do to navigate and to forestall such incidences. Because we know when we have surplus, this reflects low burn rate, and as a result of improper planning, that may likely entail a refund to the donor or a request for no-cost extension, as the case may be if you are at the end of a project. That is, by project closeout, you may either request for a no-cost extension in order to extend the period of implementation, or it may likely cause for budget realignment. That is one. The other leg, if you have shortages, this may entail delays in settling your bills, and this may actually have impact on your program implementation, as you may likely will not be able to meet up with your program targets and the objectives according to timelines. So that is why we're looking at this topic, cash flow management, in order to assess our liquidity position and to avoid the negative impact of not planning well. So having enunciate some of the benefits of cash flow management, let's look at the key components when it comes to cash flow management. One of the key components we are looking at is the cash inflows. These are funds that are coming into the organization. In a typical NGO setting, examples of cash inflows that may come into an organization are donor or grants received from either local or international donors. You can receive funds through membership dues and subscription. You can receive funds into an organization through donations and fundraising. And NGOs can also raise service income through training and consultancy services. You can have income or funding into the organizations by way of investments. Those incomes are flows into the organizations, and they are all categorized under cash inflows. The second key component is the cash outflows. As the name implies, outflows. These are payments that are going out of the organizations. Let's look at typical examples of these outflows from an NGO. These are program expenses by way of training or outreaches. You have the personnel costs, make payments to pay salaries, fringes, and other staff benefits. These are outflows from NGOs. You have overheads, that is admin, running costs of an organization, all categorized under overheads. Their expenses and their outflows are from the organizations. You may make expenses and payments by way of travels and logistics. These are categorized under the outflows. And you may likely have statutory payments like tax and pensions and other regulatory fees as required by government. These are all ways of making payments out of the organizations, and all these payments are categorized under cash outflows. Let's look at the third key components of cash flow, which is cash flow. As earlier explained, the forecasting is about estimating future inflows and outflows so that you can anticipate surpluses or shortages as the case may be. And this will help in planning ahead and making informed financial decisions in case, or just to assess your liquidity position in case you may have shortage at the end of the day, or you may have surpluses at the end of a particular period. And you now know if there are going to be shortages, you can estimate where more funding will be coming from to cover those shortages. Or if there are going to be surpluses, you can plan ahead to reprogram or rework your work plan activities so as to apply those funds that are in excess, or you can decide to invest the excesses at the end of the period. Liquidity control, which is another component of cash flow management, is a process whereby we ensure that organization maintains the right balance between having enough cash for operations and not keeping too much idle cash that could be better invested. Just as I earlier said, liquidity control is just to ensure that the organization is solvent at any point in time and it can meet up with its contingent liabilities and any other unforeseen payments that may crop up. Let's look at some of the importance of cash flow management. One of the importance is it helps to track donor disbursement against project timelines. You know, most of the times funding comes from donors and it comes in tranches. As they are coming in tranches, it's expected of us to have our work plan tied to those tranches. As the funding is coming, we know what and where to apply those fundings. This is one of the essence of having a cash flow forecast, so that whatever you have in your work plan should be tied to the funding that is coming from the donor at any particular point in time. The second importance is it helps to maintain financial stability and to avoid insolvency. Insolvency is where an organization does not have any cash on hand to meet its own commitments, to meet its own payments, either by settling bills, by paying salaries, by paying some creditors if need be. So this helps us to maintain our financial stability by way of assessing our liquidity to ensure that we're on top of our game and no activity or bills are not paid on time. The other important is to support our project continuity. Where there are no funds, there is nothing an organization can do rather than to start waiting and delaying implementation, which will affect the project continuity, and ultimately our program goals may not be likely met. Cash flow management also helps us in strategic planning with our finances and investment decision. As earlier opined, where you are going to have some excesses, it can inform the management to know where and where to put up such resources instead of sitting idle in your funds, in your accounts that is not yielding anything. Management can decide to say either to realign or to work on the work plan or to apply the excesses somewhere that will be of benefit to the organization and the donor. Then again, with good cash flow management, this builds trust with our partners, trust with our donors and creditors. Can agree with me that when it comes to payments, when it comes to funding your activities, where there are lack or shortages and you cannot meet up with your commitments, it negates your trust with the partners and the stakeholders we are dealing with. It sends a negative signal and a bad image to the organization. Now, let's look at the cash flow management process, what it takes, and the process that we need to follow to ensure that we keep to good practices when it comes to management of cash flow. The first step is planning. You are required to prepare a cash flow projection that will align with your project work plans, as I earlier said, because the funding comes in tranches, either by true donor or fundraising. You have to align your work plan. You plan your work plan to align with the expected fund you are to receive. And then secondly, you have to monitor your actual receipt and the payments you are making periodically. It can be weekly, it can be monthly, or you have to track the actual, because at the end of the day, the actual may be different from what you expected due to some factors that are not within your control. So it's very good that you track your actual receipts and the payments, which ultimately results to variances. At the end of the day, you have to look at the variances and then justify why those variances are coming up. It may be positive, it may be negative. Negative in the sense that you are spending above and beyond your budget and estimates. Favorable if you have some surplus that are within the set minimum percentage by a donor. Then the other step that we look at in the management process is a control. You need to control your cash flow. Controlling it by way of delaying or accelerating certain expenses as needed. In instances where you may likely have shortages at the end of a particular period, looking at your funds, you may try to delay some of your expenses or implementation while you are waiting for funding to meet up with those expenses. And in certain instances, you may decide to accelerate those expenses by speeding up your implementation in order to mop up excess cash that you have on ground. So these are the control. Whenever you are tracking your funding, you have to either accelerate or delay certain expenses so that the funding keeps matching what you have to spend at any given point in time. And then, as I said earlier on, you have to produce a report that shows your variances and to justify the differences between actual and the projected cash flow. Differences bound to occur between actual and the estimated forecast. So you should be able to justify why you're having surplus or why you're having deficits at the end of a particular period. So let's look at a typical cash flow statement so that it can help us to drive home the point we are trying to make. This is an instance we are using a hypothetical case here, an NGO called Youth Green Revolution Foundation. Usually, a cash flow statement is broken down into three categories: the operating activities, the investing activities, and the financing activities. The operating activities is just about the day-to-day business operations, the core activities that generate revenue and expenses. And it shows us how an organization can generate enough cash to sustain itself without relying on any external borrowing. So in this case, the cash flow from operating activities will look at the day-to-day operations of the organizations. We look at the income and the outflows that are covered under cash flow. These are just a typical example. First and foremost, we look at the inflows. In this case, grants received from donors, we say it's 42 million. Inflows by way of membership subscription, 1.5 million. Local funding proceeds, that is through fundraising, we have 2.2 million. And then interest income, either by way of bank, some bank accounts that yields interest, you have 300,000. So your total inflow for a particular year, in this case, we're looking at January to December 2024, which is a period of 1 year. Total inflow for that year is 46 million. And then you now step down to look at your outflows. Program implementation is by way of training and workshops, 26.2 million. Salaries and benefits of staff, 10.5 million. Office rent, monitoring and evaluation, communication, stationaries and office supplies, travel and other logistics. So everything, the outflow or the payments for that period within the year period totaled up to 43,700,000. Now the net in this category of operating activities, you need to subtract what you spend from your total inflow, and to leave you with that is 46 minus 43.7. You'll be left with about 1.3, 2.3 million, thereabout. Then you now look at the next category, the next component of the cash flow, which is investing activities. Investing activities here relates to purchase and sale of long-term or fixed assets invested by way of investment in the organization. It indicates how much the organization has invested in infrastructure to support long-term goals. So all activities, all operations that falls under these investment activities, just to make sure that the long-term goals of the organization has its own backing. They are all categorized under the investing activities. Here, the typical examples here we have is when you purchase office equipment like generator, 800,000, purchase of laptop and other IC tools, and then you have proceeds from sale of old office furniture. These are all part of your investment for the period. So you categorize them here, and the net, by the time you add what you spend on investment and what you receive under the sale of your assets, you have 1.250 million. That is under investing activities. Then the third category, which is the financing activities. The financing activities is actually cash movement between the organization and its owners, creditors or stakeholders. It shows the organization how it raises and repays funds to support its operations. So examples here, when you raise a short-term loan from partner organizations, that is an example of an activity under financing activity, because you are raising the loan to support your operation outside the normal grants from donors. And then when you repay your loan or any interest on loan, all these things are under the financing activities. And like in this example, the net comes to 300,000. That is when you deduct 200 from 500,000, you have 300,000. Then what you now be looking at under the cash flow statement is to put the aggregate of these three components together. Like from what we did here, the net cash flow from operating activities is 2.3 million. The net cash flow from investing activities that we saw up here is 1.250. It's in the negative. When you see a figure in bracket, that is it's an outflow, a negative figure. And then the net cash flow from financing activities is 300,000, as summarized above already. So under this net increase in cash and cash equivalent, you are having a total of 1,350,000 from the aggregate of the three components that we have just explained. Now, at the end of December 2024, what you have is 1,350,000. That is a surplus you have at hand as at the closing of that year. So this 1,350,000 is being taken into the following year, January, which will be your opening cash balance. This opening cash balance may either be tied to something else, either reprogramming it or investing it elsewhere, while you are expecting additional funding from the donor, from the tranche of that year. So from this, you have an idea that you are liquid up to December 2024, and that whatever you need in January is just an additional fund with 1.350. So this is just an analysis of how you can assess the liquidity of an organization. We now go into the next subtopic, which is expenditure management. Expenditure refers to the financial costs incurred to operate and fulfill mission, which can be categorized into direct program costs and indirect or administrative costs. Expenditure is just what you spend to obtain value for services and goods. And here, the emphasis is on value for money. Whatever money you spend, since it is donor-driven environment, you have to ensure that there is efficiency, effectiveness in the process of disbursing and making payments. Whatever you spend should be justified as having those three keys of showing value for money. And as I said, this expenditure can be direct or indirect. Direct in the sense that if they are related to program costs directly, these are categorized under direct program costs. But if it is indirect, indirect is just the overhead that you spend that are not directly related to any of the program deliverables. These are all overhead expenses. And the essence of expenditure management is for us to be systematic in planning, authorizing, control, and record and report all the organizational spending to ensure that resources are used efficiently, transparently, and in line with donor and organizational objectives. This is where we have the idea of cost principles, which is a topic on its own for another day. This gives us an idea of where costs can be disallowed or allowed based on donor agreement of what should be reported to them as expenditure at the cost in the course of our operations. Before we look into the categories of NGO expenditure, why do we need, what is the essence of managing our expenditure? One of the reasons for managing our expenditure is to ensure proper use of funds according to donor and internal policies. Because if proper control and management is not taken care of, at the end of the day, the organizations may risk the possibility of refunding back some funds back to the donor because they may be disallowed at the end of the day. Another reason for expenditure management is to prevent extra budgetary spending and waste or fraud at the end of the day. And expenditure management also promotes transparency and accountability, where donor can assess that you have your process of expenditure is very transparent and accountable. This gives them the trust that they can continue in this relationship going forward into the foreseeable future. And it also serves as a basis for ensuring compliance. And then the other importance is that it's basis for quality and accurate financial reporting. When you have a transparent process in terms of your expenditure and expenditure management, it gives a very good ground for quality and accurate financial reporting. Donors can look at your report and they have that trust that you are reporting the right thing at the end of the day without any suspicion of cutting corners or wasting their resources, as the case may be. So let's look at the categories of NGO expenditure. Typical NGO expenditure are categorized into 4. First and foremost is the program or project expenditure. These are direct costs, as I earlier said, direct costs that are tied to donor-funded projects by way of training, community outreach, materials, consultancy, logistics that are directly tied to program implementation by way of trainings. And you can directly link it to your deliverables that are tied to those programs you are implementing according to your work plan. The second category is the administrative or operational expenditure. These are overhead. They are not directly tied to any training or program implementation, but they are very, very essential in the implementation of those programs. Such expenses are such things like rent, staff salaries, most especially where staff salaries cut across projects based on level of efforts. You have utilities, office supplies, all these things are covered under operational expenditure. The third category is the statutory expenditure. Statutory expenditure by way of mandatory payments such as taxes. You have to pay withholding tax. You have to pay, that is withholding tax withheld from customers and other vendors you dealt with. That's good.
Please, briefly, before we continue our session, for those people that are just joining us, please do well to check the chat box and introduce yourself, your name, your organization, your location, and also take the pre-test. That's why we have this quick break. Please do well to check the chat box, your name, introduce yourself, your name, your organization, and your location, and also take the pre-test. The pre-test is to ascertain our level of knowledge as regards this topic. Thank you so much. Please, FM, continue, sir.
All right, as I was saying before now, we're looking at the categories of NGO expenditure and we're looking at statutory expenditure. And I say that the statutory expenditure, aside your expenditure that are related to program deliverables and overheads, which are by way of taxes, withholding tax, pension, social insurance, or regulatory fees by government. These are statutory expenditures that you have to pay in compliance with government regulations. And then you have the capital expenditure. These capital expenditures are all your expenditures on long-term investments, like office equipment, vehicles, or building improvements. Suffice to say that these expenditures that are capital in nature have to be sometimes amortized by way of depreciation. So you allocate the part you use for that year because the duration for the use, it generates revenue over a long period of more than 1 year. So you have to apportion by depreciating it and expensing in a particular period to capture the actual expenditure over a period of time. So all these ones are applied under capital expenditure. Let's look at expenditure management process. For a credible internal control and management of expenditure, these steps are recommended and they are standards for you to ensure that you are controlling and you are managing your expenditure to avoid either wastage or any other gap in your expenditure cycle. One of the steps is budgeting. Budgeting in NGO setting the benefit cannot be overemphasized. You are required to develop a detailed annual or project budgets so as to know what you are planning to spend on and what may be the cash or the fund inputs at any given point in time. And the purpose is for you to set financial limits and spending priorities because you have the budget and you know that you know the amount of what you're going to spend at the end of the day. The budget guides you against extra budgetary spending so that your spending will be limited within the confines of your budget, which is drawn from your work plan. The second step you need to look at is authorization. There should be authorization levels. Approve expenditure through delegated authority levels. In organizations, you have different strata of management from the tactical, operational, and the strategic. Along those stratas, you should be able to have a schedule, a band of authorization in terms of the amount, in terms of who is to approve what, and even the threshold. These are specified in your financial policies or internal control policies so as to safeguard against extra budgetary spending. Another thing you need to look at carefully is a procurement, where you purchase goods and services. This should follow policies and donor rules. And what is the essence? The essence is to achieve value for money and transparency. You have a procurement policy and you should be able to abide so that when it comes to procurement, there are policies that guides either what do you do when the threshold is within so amount. Do you need to set up a procurement committee for certain threshold of expenditure? Or how many quotes do you need when you are about to expend on procurement of some certain threshold? These are all spelled out, and the procurement policy should be detailed enough to guide expenditure in line with budget. And then when it comes to payment processing, the finance have to come in to verify if the expenditure emanates from procurement. All the necessary documents have to be verified. The processing of the payments also, delegation and segregation of duties comes in where you checkmate everything before the final processing and payment is being done. This ensures accuracy and legitimacy of any payment that goes out of the system so that if there are lapses, if there are gaps, such can be highlighted and corrected at the point of processing that payment. Then after the payment, recording should be done in line with your all required documentations. If you have your accounting system, software, these records of payments will be done to capture all expenditure. And then you are reviewing all those expenditures at the end of every month vis-a-vis your budget for that month, which is your basis for financial records and reporting. And then the next step is to monitor and control. Monitoring and control here entails you comparing the actual and the budgeted expenditure so that where there are variances, you can take corrective action. Because when you spend above the budget, going by some certain percentage, most donors will specify 5% or 10% variance above and beyond your budget. So if you spend beyond that 10% or 5%, as the case may be, you have to justify why you are spending above that. And there are so many factors that may prevail and warrant you to spend above budget. sometimes even if you are under spending, it requires that you justify why you cannot spend beyond what was budgeted for or less than what was budgeted for. And at the end of the day, expenditure management requires that you report. You report and submit expenditure reports to management and donors for their own informed decisions and subsequent funding. Because some funding may depend on milestones of what you have expended from what has been given to you. And it will now be reimbursed and the cycle continues. So these are some of the processes you have to ensure that it's on ground to ensure that expenditures are managed properly. Now let's look at internal controls when it comes to expenditure management. And these internal controls are set up to prevent fraud, misuse, or misappropriation of funds. NGOs must apply strong internal control mechanisms, such as these key 5 steps highlighted here. First and foremost, a good internal control when it comes to expenditure management should ensure that there is segregation of duties. Segregation of duties here entails the fact that from the point of initiating a request to ultimately result to payment and up to the point of payment and recording it, those processes should be segregated. No single individuals is required to make a request, process it, make the payment, and then document it. At least in between those chains, between request and payment and documentation, there should be at least 2 or 3 steps. Each person checkmating what the other person is bringing as input to ensure that the financial controls and internal control put in place are being observed. So there's separate authorization, processing, custody, and record keeping. All those stages are separated and handled by individuals. The second internal control is to ensure authorization limit, just as I said earlier on. Authorization limit in terms of the request, authority levels, approval levels have to be spelled out in terms of request and then the payment itself. Going by the cadre and the management you have on ground, the chain of command and control. You set this up so that individuals can be held responsible where expenditures that are approved are not within their own threshold. Then, of course, supporting documentation. After you must have made your payment, you have to ensure that every payment is backed by invoices, receipts, or contracts, either contract with consultants, contract with vendors, or documentations have to be supported if there are payments. Then you have to reconcile your accounts on a regular basis, either weekly or monthly, and mostly with your bank statements. You have to ensure that whatever that has been expended is authorized and approved, and that is what is reflected in the bank statement. Any unauthorized payments that is found in the bank statement is a red flag that will call for investigation. So these are ways of ensuring that what you are spending at the end of the day are all in line with approved mandates. Then you need to ensure periodic audits. You have to conduct internal and external audits. Internal audit is just like a control, an assurance that yes, everything is in line with the stated financial policies of the organizations. And then the external audit ensures it gives additional assurance that what you are doing is in line with what is required of the organization, that proper books of accounts are kept and everything is in line with internal financial and internal financial documents, rules and regulations, and donor requirements. Suffice to say that external audit is an independent examination of your books outside the internal control auditor or officer. Now, in the process of disbursing your funds or requesting for those funds, it behoves on the organizations to have a standardized expenditure form with which anybody can have access to review and to ensure that all payments are done in accordance with set out rules and regulations. And one of these, by way of explanation, standardized expenditure forms refers to a uniform pre-approved template used across the organization to record, request, and authorize spending. The templates you have on ground, it may be hard copies, it may be online templates that can be accessed and approved. These forms make financial documentation consistent, traceable, and compliant with both internal and donor requirements. And some of the benefits of using these standardized forms are it promotes uniform record keeping across projects. It simplifies auditing and reporting processes because when an auditor comes to your organization, what that auditor is looking up to verify is your documentations. So you have to pull out all the documentations, all the payment vouchers, your petty cash vouchers, your procurement documents, everything that has to do with your expenditure for verification. And then one of the importance of using standardized expenditure form is that it reduces error, omissions, or fraudulent claims. Because as I said earlier on, as the documents are being moved from one point to the other in the chain of selection of duties, anybody can detect if there is an error and then call the attention of whoever is processing, wherever those documents are coming from, to make necessary correction before it's being omitted by way of oversight. And then it enhances accountability and transparency. Everything is open for anybody to see and verify. And it ensures compliance with donor and internal financial policies. These are some of the benefits when you use standardized forms, because you can't use one form today or 1 year, and the following year you are using different templates. There is no consistency. And where there are no consistency, it gives room for fraud and mismanagement of funds. So let's look at some of the common types. Let's look at some of the types of standardized forms that we can use when it comes to expenditure. Requisition form. Requisition form is used by departments or staff to request for funds. That is, the initiating unit or department or staff needs a requisition form. That is one of the forms that you can use to initiate a request before you can make expenses. You need to have a form with which to request for funds where there is need, either for procurement or for making some payments. The second form that you need is the payment voucher. The payment voucher is used to process the payment, either for advance or procurement. It is used to record and authorize payments, including details like payee, the amount, the purpose, the budget code are indicated as some of the features of a payment voucher. And then the other document you can use is the petty cash voucher. Petty cash is just for small internal spending, day-to-day spending that are small in nature. These are used for small cash payments. You process these payments using the petty cash vouchers out of the petty cash floats to ensure control over minor and daily expenses. These are kept in the till, and at the end of the day, you do a surprise cash count to show that what you're spending from the petty cash float is according to financial policies, and the amount tallies, or the total at the end of the day tallies with the total flow that you have. And by the time you have expended it, you are allowed to replenish it. So the petty cash vouchers has its similar features like that of payment voucher, but the amount differs and the operations also differs. Then we look at the purchase order. The purchase order is a document that is issued to a vendor just to confirm approved purchase details. On the purchase order, you have details like the quantity, the price, the deliverable, and the timing of the deliverable, and the specification of the product or services you are requiring for. All these are captured by the on the purchase order, usually issued by the procurement officer. And then the other one that we have is the travel expense form. The travel expense form is to capture all expenses that comes by way of traveling, staff traveling, or vendor that you engaged. And these details cost like transport, accommodation, per diem, your flights, local airport taxi, all these expenses, or even mileage that come by way of travel, they are being captured under such a form called travel expense form. And the other form we have is activity or event financial report form. As NGOs, we carry out activities, we implement programs in the field by way of training, by way of outreaches, advocacies. All your expenses are now categorized using this form to summarize your expenditure, either where it entails hotel accommodation, your meal, refreshment, lunch, community engagement, participant transport, participant allowances, everything that goes in hand with that training are captured under the activity or event form. So this brings us to the end of the end of this topic, having considered cash flow and expenditure management. So the floor is open for questions, comments. Thank you for your attention.
Thank you so much, facilitator. So you can react with emojis if you enjoyed the session. So please, if you have questions, you can please raise your hands so we can, facilitator can attend to your questions, please. If you have questions, you can signify. Does anybody have question? You have to tell me that we understood 100%. Okay. Okay. Okay, we have questions. We have two people. So Tabawa Sule Atiku, can you please unmute and ask your question?
Yes. Question session.
IT, please help him unmute. Tabawa Sule Atiku. Okay, we have Ibrahim Bello. Can you unmute yourself and ask your question? Just check.
Okay, good afternoon, everyone.
All right, thank you. Welcome, sir.
And thank you very much to the facilitator for a wonderful presentation. I joined a bit late, but what I was able to catch up with was quite insightful. My question is around the annual financial budget. I understand how important it is for an organization to plan its financial year. However, my question is there a template, a standardized template that perhaps could be shared that could guide how the financial plan or the annual financial budget can be developed? That is one. Now, secondly, the second question is this budget is usually based on estimates of sources of revenue to the organization, and then you plan in line with your programs or your interventions for the year the year in view. Now, in the event, and of course, I understand that this has to go through the board's approval. In the event you are able to generate revenue that was not envisaged in that plan for the year, what is the ideal thing to do to be able to expend that budget? Let's assume you did not expect a particular funding from a certain donor, and halfway into the year you were able to secure that funding from that donor. It was not budgeted in your annual financial budget. What should you do? Thank you very much, sir.
Okay, can I respond to this before we take another question?
Yes, sir, please do. Please, we've sent a post-test link. Please do well to fill it on the chat box. Thank you. So you can reply.
Okay, thank you for the question. Before I answer these questions, let me try to clarify something. We should, there is a difference between a budget and a cash flow statement. There are two different things. A cash flow statement is historical and captures actuals, while budget is a plan of estimated income and expenditure. Budget is futuristic, while cash flow is somehow something that is actual and current. And then the cash flow tries to assess your liquidity in a particular period of time, while budget sets financial targets. So these are key differences between cash flow and budget. And coming to your question, you were saying if there is any standardized template for budgeting. There is no standard template for budgeting because it depends on the donor and the management of an organization to come up with a particular budget template. Because if you say a standardized budget template, some of the expenditure or some of the expected revenue that is expected by one organization may not be what is expected by another organization. And expenditures differs from organization to organization. So you try to customize templates that will suit your own revenues and expenditure at the end of the day. Looking at the categories of your expected revenues and then expected expenditure. Some organizations may not even have expenditure for capital expenditure, or even what is it called? The revenue may not be from fundraising. So these are variances that may not all go away to have a standard template. But where the need arise, the organization should be able to come up with a template. And most of the times, the donor provides a template that will guide your budgeting process. I don't know if I'm understood. And again, you said if there are surplus by way of revenue, some revenue came in and you were not expecting it. Yeah, that is the essence of cash flow analysis. If there are surpluses, if there are revenues that you do not expect in the period of implementation, it behoves on the management to now decide what to do with those funds. They can decide to realign or work on their work plan and realign their budget, bringing in more activities that can be implemented by those funds. And if there are none, other alternative is you can invest that surplus in a liquid asset, pending when there is need for it, and you can call it as time demands. Investments like mutual fund are readily available at any point in time that you need it. You can invest it while it yields returns for the organization. So these are some key ways you can manage your excesses or surpluses by way of revenue. Thank you.
Thank you, sir. I hope we understood. So we have another question by Salmanu Mohammed. So can you please unmute and ask your question? You have 1 minute, sir. Salmanu Mohammed. Okay, feels like the person cannot The person is not available. There's a question at the chat box. The person said for a young NGO that is starting up, that is starting operations, do all of these apply? So I think all of the procedures you have mentioned in FM, the person is asking for a young NGO if all of those process applies.
Yeah. Okay. Thanks for that question. For a young NGO that is commencing business, it actually applies because first and foremost, you have to analyze your revenue. Yeah, your funding. Is it coming in tranches or is it just one-off? Is it going to be a reimbursable grant? So there is need for cash flow analysis so that you will not run out of cash or run out of fund in the course of implementation. That is the essence of cash flow management, to ascertain your liquidity position so that a fund that is provided for maybe 6 months period, you ended up spending it in 3 months. And the remaining 3 months, you have nothing on ground to implement again. So that will tell negatively and impact negatively on the operations of the organization. And expenditure management, as I emphasized earlier on, the benefits cannot be overemphasized. This calls for attention and monitoring your expenditure so that the actual can be compared with what is being budgeted, and whatever you spend is efficiently spent and justified with supporting document, quality supporting documents that anyone that is verifying your documents will say, oh, there is no wastages and they're efficiently managed. So a new NGO that is just trying or commencing operation, these are applicable. Thank you.
Thank you, sir. I still have Salmanu's hands up, but I think he has not been able to unmute himself. Meanwhile, please check the chat box, fill the post-test form, and also the training evaluation form. They are important to help us assess our impact in this training. Does anybody have any other question? We still have about 1 minute for that. Okay, so I think we are good, sir. I think we are good. We appreciate your session. This has been very educative. Please do well to follow our handles so you see the next training link. Just do well to check your email because this happens second Thursday and last Thursday. So by next month, we will also have 2 sessions. So do well to check your calendar, check your email so you can follow up. I'm sure it has been very helpful and it has been very impactful. So just to know that we are here, please, can we react with emojis as we're about to wrap up? Can you respond with your favorite emoji so I can know that there are people here? Okay. So thank you very much. Do have a beautiful day. I saw some people asking about the presentation slide. They will be sent to us via mail. We will receive them. So thank you very much. Do well to apply these things you have heard and you have learned. Have a beautiful day. Thank you so much.